Do you think Reserve Bank of India is doing the right thing by not freely intervening in the forex market?
Well, yes and no. Let me elaborate that answer a little bit. I think the only way to stop this slide, given the basic gap in demand and supply, is for the RBI to intervene on a significant enough scale to change the sentiment in the market. On the other hand, this would be money wasted unless it is going to be accompanied by many other measures over which the RBI has no control. For instance, the fiscal deficit, for instance, the FDI policy, for instance, the land policy, for instance, the environmental regulations. Now it is the tax changes. All kinds of things are affecting sentiment about India. So merely halting this slide, I think, will not by itself do anything. It may stop there for a month or two, and again we'll see the same kind of things, unless the total sentiment about the country is changed through the various other measures in terms of the macroeconomy, which I just now referred to. Otherwise, it's a waste of foreign exchange reserves and sucking in the rupee liquidity. And I think availability of rupee liquidity in the market is, as it is, quite tight. So I think it will be counterproductive unless it's a part of a total package.
Indranil, what is your sense on which way the rupee may be headed? Because clearly the weak rupee is a concern. What tools, according to you, does the RBI have to intervene at this point in time?
No, I think Mr. Rajwade made the right points in the sense that the macroeconomic conditions for India are definitely weak, no doubt. Therefore, to a certain extent, there is hesitancy from the foreign investors to sort of put money immediately into the Indian system. But having said that, I think the RBI as well as the Indian economy also needs a slice of luck from the international scenario. The Indian economy and any emerging market economy would not be possibly able to sort of withstand the type of risk aversion that we are seeing. In fact, India has anyways been a current account deficit country, but we also see some of the Asian region countries which were current account surplus countries gradually tipping into a current account deficit zone, which necessarily means that the Asian region currencies as a whole is likely to remain under pressure. So first, the global situations in terms of the financial markets, in terms of a resolution to the European issues, etc., needs to be sort of addressed. And that is one luck that we would be looking at. The second is the luck from the oil sort of market. Because what we were expecting in terms of the current account deficit is that the high gold prices, along with the depreciated currency, would enable some sort of a depression in terms of the dollar value imports of gold. That might not also sort of take shape, because we have seen the landed rupee price of gold also having come down from their recent peaks. So it's a sort of a mixed scenario at this point in time, and I think I would side with Mr. Rajwade in saying that the RBI needs to keep its firepower intact, because we really don't know exactly what lies ahead. If Greece actually is forced out of the euro, it can lead to a significant amount of contagion reaction in the rest of the European region, especially the PIGS economies, and can also translate into the emerging market economies too.
So, Indranil, what tools does the RBI have to protect the slide in the rupee? Because clearly whatever they've been doing up until now hasn't quite been working.
I wouldn't say it hasn't been working, because to a certain extent they did change the fundamentals of demand and supply after they did those FII auction in the GSEC and corporate securities on 30th November. We did have a significant amount of flows, and the rupee dollar did sort of turn from its trend path. Subsequent actions on the NRI deposits also have helped to a certain extent. The capping of the EEFC account to 50%, that should also sort of bring additional supplies in the market. I know that they are small amount. But going forward, I think the point that needs to be noted is that the RBI really needs to restrict its firepower when actually it is needed. And we are actually facing today what is a fundamental gap between the demand and the supply of dollars in the domestic market. The supply of dollars is weakening because we are sort of looking at lower flows from the global scenario. The European banks are deleveraging, and the whole Indian system is more heavily reliant on European banks for flows rather than the US banks. So that is something that we need to very carefully look at. And there appears immediately to be very sort of few reasons to say that the current account deficit would suddenly sort of correct significantly from a projected level of 4% of GDP down to around, say, a 2.5% of GDP, which appears to be the more comfort zone. So I think these are the various sort of macro juggleries that need to be sort of taken into account in terms of the way RBI needs to act in this market.
Pradeep Khanna, you have the pulse of the rupee market. What is your sense? Do you think Reserve Bank of India intervened yesterday and Reserve Bank of India has also intervened today?
Yes, I mean, the RBI has been in the market pretty much on a daily basis for a while now, and I think is pretty much in line with their stated policy of smoothening smoothening the way or reducing the volatility at times when it tends to become extreme. So yes, we have seen them, but I think by their own statements, it is nothing more than that. It's not really an attempt to defend a level or decide a rate for the currency, but it's simply an attempt to smoothen out the path.
Pradeep, what is your understanding of the technicals of the rupee market? Do you think the short trade is getting too one-sided, and if global risk reduces or if Reserve Bank of India intervenes aggressively, rupee could seriously reverse?
Well, if you look at it, I think I agree with a lot of points that the other two guests before me have just stated. Current account deficit is very high. There are a lot of macro things which need to be done, which is not really in the RBI's hand, which need to be done by the government. And, unless, there is a complete global meltdown and oil price, goes back the way it did in 2008-9, we are unlikely to see a very significant reduction in the current account deficit anytime soon. Now, in that scenario, I mean, you have a structural, gap between your dollar demand and dollar supply, which you have been dependent on foreign investors to kind of bridge. In this scenario, of an iffy sentiment in Europe, I would say at best foreign investors are going to wait and watch. I would really not expect them to come flooding in fresh investments unless either the environment clears up and the view becomes a lot better, or else, the value of the Indian assets goes up significantly and they start looking cheap. Now, that could happen either if the stock market really goes down or if the rupee really weakens, because both of them, would have the same effect of making Indian assets cheaper in dollar terms. So, if this is how the scenario is going to play out, and that's what it looks quite likely at this point in time, then, really the path of least resistance and the only logical path is to allow the currency to weaken. And if one doesn't want a panic-like situation and one doesn't want extreme volatility, then it's probably, what RBI is doing is for the best of smoothing out the volatility. But I would actually think that, for a structural problem, not a seasonal or cyclical one, which could just get passed over by intervention for a short duration of time, but if it is a structural problem, then I think it would not be very wise to just stand there and use up a tremendous amount of reserves for a problem that is going to continue to exist. It's probably better to guide it along the path which is, looks most logical at this point.
Right. Mr. Riswal, I just want to get you in on what tools does the RBI have really at its hand to, help protect the slide in the rupee. And also, it seems like, the RBI, while its intervention seems to be leaving the rupee to perform as per the market conditions. In that case, can we see a further slide in the currency to say, 56 to 57 levels?
Well, I rarely ever predict levels because I think levels depend on sentiment, not just changes in demand and supply. But having said that, I, as a student of the currency market for so many decades, I think the RBI does not speak the whole truth when they say that they intervene only in the times of volatility and to smoothen it. I think we have had a dramatic change in the exchange rate policy in the last 3 or 4 years. Until that point of time, say 4 years back or 3 years back, there was a far bigger level of intervention on a day-to-day basis. They were trying to keep the real value of the currency within reasonable margins around a neutral level. They use the RER index. I mean, RER index to my mind has a lot of weaknesses, etc. But that apart, they were trying to do that. Last 3 or 4 years, I think there has been a dramatic change in the policy, unannounced, undiscussed, undebated, and they have shifted to a market-determined exchange rate. Now, the rhetoric they use, namely that they intervene only at the time of volatility, hasn't changed. It was the same from 93 to, say, 2007 or 8, and the same thing continues now. So that's not quite the whole story. I think there has been a dramatic change in the policy. I don't know, because we didn't want to side with China as a currency with a managed exchange rate. This is also reflected on how the IMF describes the rupees exchange rate policy. Coming to sort of just one other point. So I think the RBI, what it has done, November, December, or now in terms of EFC, these are palliatives. They don't cure a structural problem, which is a huge current account deficit. And while we compare ourselves with other Asian currencies and the problems they face, the fact is that most of them are surplus currencies. Most of them are surplus economies and countries, while we have a huge 4.3% deficit on the current account. Now, 4.3% is not a small sum at all. I remember that there used to be a lot of discomfort when the current account exceeded, say, 1.5% of GDP. So we seem to be complacent. And I think that's a very risky thing to do in times like these.